This podcast is sponsored by Rask Invest, Owen's complete guide to money and investing. Visit the Rask Finance website to learn more and join today.
Hello, and thanks for tuning in to the Australian Investors Podcast, a series exploring the investment philosophies and journeys of some of Australia's leading investors and financial thinkers. I'm Owen Raskovich, founder of the Rask Group. For show notes and other episodes in this series, as well as free educational resources, please visit www.raskfinance.com. Before we go on, it's important to remember the Australian Investors Podcast is provided for educational purposes only and should not be relied upon to make an investment, financial, or taxation decision. The information included in this podcast does not take into account your needs, goals, or objectives, and guests appearing on the show may have a financial interest in some of the products mentioned. Please read all the important disclosure documents and refer to the Rask Group's Financial Services Guide on the Rask Finance website. Sebastian Evans is Managing Director and Chief Investment Officer of NAOS Asset Management. Sebastian spends most of his time sifting through the smallest companies on the stock market, and when he finds the right opportunity, he is willing to take a very big stake and hold the shares for many years. Sebastian takes us through what he looks for in businesses and in management teams, the benefits of running a listed investment company, tricks and traps for small company investing, and his favourite podcasts. My favourite story from Sebastian is him asking friends and family for some help to buy NAOS, a decision which set him on a path to becoming one of Australia's most respected small company investors. Considering he is in his early 30s, I was very impressed with his level of insight, but also his transparency and humility. I think you'll enjoy this conversation with Sebastian Evans of NAOS Asset Management. Sebastian, thanks for joining me on the show.
No, you're right. Thanks for having me.
When I was doing my research on you, I got to admit there wasn't as much content or information that I could draw upon as perhaps some of our previous guests. So I'm going to be led by you with some of your history and how you came to be in the position that you're in today. Yep. So let's go back to the beginning.
Yep.
Where did you grow up and where did your journey towards investing begin?
Yeah. So first of all, thanks for having me. But yeah, as I tell all of my investors when I'm pitching for money or shareholders, we're not the usual funds management business. The usual funds management business is, I've worked at UBS or I worked at a big funds management firm and I made so much money that I thought I'd leave and start my own. It's the complete opposite of that. So I'm a Sydney born and bred, born in Manly, or grew up in Manly for a little bit and then moved around. And I suppose the only point that really matters is when I was very young, my parents separated, but it was a little bit different in the fact that my old man brought me up. Okay. Normally it's not the case, many years ago. And Dad was a broker and he was the original managing director of Macquarie Equities, so he always invested in equities. I was always around it. As I told you previously, I had no interest in getting into the industry. I always wanted to do something else. At one stage I was learning to fly and wanted to, fly around the world, work for Qantas or whatever.
Nice.
Yeah. And then I suppose it dawned on me that maybe, I remember the flight actually, maybe this probably wasn't for me. I don't know if I want to sit in a plane for 14 hours and never be around home. And so I finished school, did a commerce degree. Unfortunately, I wasn't bright enough and I was extremely lazy that I didn't get into Sydney or New South Wales. So I went up to Queensland, went to Bond, didn't even get into a commerce degree there. So they made me do business.
Is that Bond on the Gold Coast?
Yeah, on the Gold Coast. So they made me do business, prove myself. So I had to get through stats and business mathematics, which at the time, it sounds easy now, but at the time I remember it was bloody hard, and got through it. So I did my commerce degree, majored in finance and international business, and then I did my master's in applied finance. And I came back down here and just sort of hit seek and thought, well, what am I going to do? And so I got a job at Bell Potter as basically like a clerk, sort of like desk assistant. Which was fine, but sort of found out that wasn't the first thing or the best thing that I wanted to do. I've always been reasonably, I like my autonomy, if that makes sense. Yeah. And so out of the blue, a person I've known for a very long time, since I was probably 6 months old, David O'Halloran, who's my largest shareholder, approached me. I remember he gave me 10 books. He said, go and read these 10 investment books. Get back to me in 6 months and we'll chat. And so I read these books and you would know most of the books.
Some examples perhaps?
Oh, I suppose even some of the Warren Buffett. I remember he gave me the Warren Buffett essays.
Oh, yeah.
So somebody got someone to print them off for it and say, here are all the essays, go and read them. And so I did that and then I approached him and he said, all right, well, why don't you work? He was at Southern Cross Equities, which is a broking firm, so come and work with me as an assistant analyst. He was in research. I said, that's fine. But he said, actually, I've also have a small share in a firm called NAOS, which was a funds management business at the time.
Right.
And I said, all right, well, I'll start there as a small cap equities analyst. And at the time, NAOS was part owned by Southern Cross Equities. Mm-hmm. And I started in 2007. And that was it. But I suppose the bit that everything changed was we only had about $40 to $50 million at the time. And the GFC came along and essentially, changed the industry as we knew it. And it changed it for us because Southern Cross were bought out by Bell Potter, which is a funny way of how the circle works. And they had an asset management business and they didn't want NAOS. It was losing money. A lot of our funds walked out the door. So the funds went from 40 to 6 million. It was put up for sale. But I was lucky enough that I had the people around me, so family and friends didn't give me, but essentially contributed. I can remember the figure. It was like $1.7 million. Wow. And said, here you go and buy the license, buy the name, and let's see if we can get it to break even.
Oh.
And that was it. And that was 11 years or 10 years ago. And it was me and two others. And at one stage, we couldn't afford an office for the first 3 years. So I basically just, anyone who liked us and was willing to give us some space, that was us for the first few years.
We were talking off air just a moment ago, and you were saying you're talking about your first experience giving a presentation in front of some investors.
So and I was telling you that would have been right after we were in the midst of the GFC, and I remember the person I was working for at the time at NAOS. I was all very new to this, but it's like they normally hold. I remember we had one shareholder presentation. I think that was down at one of the Intercontinental down in Sydney, and that's the first one I saw actually. So this is the second one. So that was fine. That was 2007. Everyone was very happy. And then 2008 changed. Then a few people left the business, and I remember the managing director and the chief investment officer said, "Why don't you come to our shareholder presentation?" I was like, "Okay." It's like, "Well, where's this one?" It's like, "Oh, it's down at this golf club. We're using one of their rooms." And I remember my first ever presentation, you walk in, and I think there was a string quartet of 4 or 5 people, and I think we only had about 7 people turn up on like those old primary school chairs, as I remember when I went to primary school. And the first presentation I ever did, I think the first stock I ever spoke about was Redflex, which is a Melbourne stock. Yeah, right. And they make speed cameras. And that was 10 years ago, but that would have been rock bottom. That was it right there. I mean, and to be honest, there's still one of those people who actually called the other day, is still a shareholder today, still an investor.
You left an impression.
Yeah, I think he put $100,000 in. I remember after that, I think he might have put another $100,000 in, and that was it. And then he's been with us ever since.
Oh, so, fantastic! That's a great story.
Yeah.
You said it's probably atypical for the funds management industry for you to buy another business, and especially during the GFC, would have looked pretty bleak. Can you describe what you were doing during the GFC in particular? Like, I believe that your performance was pretty good.
Yeah.
What are some lessons learned there, and I suppose along that journey and that stretch out of the GFC?
Look, I think the GFC is a funny one because I think everyone you speak to, I mean, the amount of planners and fund managers you speak to now, everyone's like, I didn't lose money in the GFC. The amount of people that seem to tell you that's quite intriguing. We don't shy away from the fact that we lost money in the GFC. I mean, you've got to remember I was very young. But I think the thing that I really learned going into the GFC and coming out, and I think if you look at a lot of people's performance numbers, is really how you came out of it. I mean, that really separated the winners from the losers, if you want to say it like that. And it was really your ability to buy quality assets at really discounted prices, and at there were no buyers. I remember buying some stocks, and it would have been all of 23. You got directors with margin loans. There was lots of that back in the GFC. I remember Challenger had a big one. Just a lot of fund managers were losing money. Everyone was getting out of small caps. A lot of fund managers just closed their small cap funds down. So it was really your ability to say, well, this is a good asset regardless of the environment. So if we take a longer term view, we're happy to allocate to some of these businesses. And in hindsight, it was the best decision that we ever made because, subsequently, everyone looks at it now and says it's obvious, but subsequently with all the quantitative easing and everything that's happened, it really put a floor under the market, and equities have really rallied ever since. But that sort of coming out of the GFC in that first 2-year period, some of these assets, if you look at CBA shares and things like that, I mean, they essentially doubled and tripled. So that's where we did very well. In hindsight, though,
were you investing in small caps explicitly?
Yeah, we've always done small caps. Yep. So we had at that time we had an absolute return fund, which is larger, so more mid cap, which we've got now as well, which is our NAC fund. So we'll always only invest in micro to mid. Yep. But I put a big disclaimer on it. Excuse me, that we say micro and small, but if you compare our portfolio to a lot of others, it'd be very small. So I'm sure you get some people in here and say I do small caps and they're $1 billion companies. When I come in here, I say I'm doing small caps. Like I'm meeting someone after this and their company, we own 20% of their company and it's capped at 25 million.
Oh, wow.
Like we really go small, which sets us apart. You'd almost find no other fund manager, I would argue, that takes the concentrated positions that we do in that smaller business, I suppose. Yeah.
So when you touched on liquidity when you said that there were effectively no buyers for shares during the GFC.
Yeah.
And now you just mentioned
the same.
Yeah, you take a 20% stake. Yeah. You're obviously very comfortable with no liquidity.
Yeah.
Very minimal.
Some people say it's my age. But no, I'm a big believer that, when people talk about performance, it's funny now, everyone talks about liquidity. And in theory, liquidity shouldn't be part of the conversation. In my view, a lot of people disagree with this, right? But if you look at a lot of people have done well over the years for whatever reason, a lot of it's in private business where there's really no liquidity. So why should it really be any different in the equity markets, especially in some of these smaller businesses? A lot of the more liquid businesses that you find are well owned. 15 fund managers own them. They speak to the market all the time. They're covered by every broker. Everyone knows what's going on. But our view is we're different because 99% of our funds are listed in LICs or listed investment companies. And what that means is no one can redeem, unfortunately, or fortunately, from our funds. So that means we can look at a position based on its return profile and not its liquidity profile, where many fund managers operate funds or unit trusts and they'll take money through a PDS or a wrap platform. That's fine. But when money comes out, they've got to start selling, liquidating all these assets. And that's where fund managers, in my view, especially ones that have done very well, and I don't, it's nothing wrong with this, is, people, if you built up a business over a long time, it's probably human nature to take less risk and be more index focused to protect your business. Are you making the best decision for returns? Debatable. I mean, people will probably look at our last year returns and say, well, you were down 15%, so how can you say that? That's a fair comment. But my view is if you look at the longer term returns, it does make a difference. And we're at the stage where we're nimble enough, young enough, and we have closed funds that we can do these positions that do put us out there. And, and when they do go wrong, you do look like an idiot. But hopefully you get more right than wrong. Yeah.
You touched on the closed-end nature of a LIC or a listed investment company. Let's get everyone on the same page. Can you explain what a listed investment company is and how maybe it differs from an ETF or a managed fund?
So a LIC, a listed investment company, is literally a company listed on the stock exchange that invests people's money into equities or debt or whatever the, I suppose, the framework is given by the board. What that means is, well, if you raise $20 million in a company, then you have $20 million to invest. You can't make that bigger or smaller. It's really dictated by your investments. So that means if people want to get into that LIC, then they've got to buy shares on the stock market, and if they want to get out, then they sell. The other way you can run a funds management business is to run a unit trust, as I said, so that's unlisted. So basically that means you go to, I think I'm allowed to say company names here, like wrap platform. So you get a Macquarie wrap or an MLC wrap and say, well, I want to allocate some money to this fund. So they take your $10,000 and put it into that fund and they issue you units. So essentially because they issue you new units, that fund gets bigger.
Yep.
It's like your savings account getting bigger. So you've got more money you've got to deploy and invest, which is fine. But if your fund gets too big, then that means you've got too much funds to invest and you've got to go invest in bigger stocks and things like that. So people tend to shy away from LICs, albeit they have been popular lately, because they are hard to grow and hard to manage, whereby a unit trust is you can take money all the time, but they can get redeemed all the time. Yeah,
okay. And there's probably some other things about it. The in the sense of like fees and expenses are slightly different. And you've got a board, like you said.
Yeah.
And there's also discounts and premiums so people are buying in and out.
Yeah.
The share price can be, I suppose, dislocate from the actual value of the portfolio that you're investing in.
Yeah, exactly.
Yeah. I want to fast forward from when you took over NAOS, and then it wasn't until, correct me if I'm wrong, 2013 or thereabouts that you launched your first
listed
LIC.
Mm-hmm.
Was that because you saw the benefits and how it appealed to your investment philosophy?
No, not that intelligent at that time. Okay. No, so as I said, we managed 2 funds, which went well. Our performance was good. Obviously, we wanted to get bigger because we're only small. We were running 35 million, I think. Mm-hmm. I remember, so you had to, unfortunately, in Australia, and this is probably timely because of the Royal Commission, you had to jump through a few hoops to get bigger. So, for a fund to get bigger, you need to be on platforms. You need to be rated. So I went through the process, got rated by at the time was S&P, which thankfully left Australia. So we got the rating and then they left. But then you can go to the rating and go to a platform provider and say, well, I've got the rating, now put me on the platform. And they say, well, we'll put you on the platform, but you've got to show that you've got $10 million of demand. It's like, well, you know what, I'm 26. I'm learning the ropes here. My fund's $35 million. There's no way I'm going to find 10. No one's going to give me $10 million of demand. So that didn't work. So I remember Dad said to me as a broker, and one of my other directors said, well, you know what, why don't we launch a listed investment company? And at that time, I had no idea what a LIC was because we were the first LIC to list after the Magellan LIC, which is now run by Chris Mackay. Mm-hmm. So years ago. So we did that. So I remember we decided in November, I think we got our prospectus and everything lodged in about 5 weeks. And my chairman, David Rickards, who's my independent chair, I remember coming down here and getting the train with Dave, who always likes to use public transport, and we just pounded the pavement and raised the smallest amount possible of $17.36 million. And that was it. Huh. And that we got it up. But in hindsight, it was the best thing we ever did because, when you look at it, because it is closed, that was NCC, so that's our micro-cap fund, and that's sort of what we're known for. It was the best decision we ever made because it is closed. We could make concentrated bets and our timing was excellent. Like our first 2 years of performance were really good. And so we've grown that from 17 to 70. And then obviously now we have 2 other LICs.
Why don't we step now into your investment process? Mm-hmm. Give us the bird's eye view. Yeah. What I suppose, what's the philosophy of the 3 funds? Yeah. And then we'll drill down.
Yeah. So I think from a portfolio management point of view, the philosophy is, remember my roadshow slide. So, really to have a long-term time horizon. And when I say long-term, we've had some investments in NCC that are still there. So they're 6 years old. We want to work with management, be supportive. And I'm a big believer in compounding returns. I mean, some of your listeners, if they've owned CSL shares or CBA shares and they've let those compound, they're probably their best investments as opposed to trading around. Then over that is really management alignment. So a lot of the businesses we back, is a bit like my own business, is we try to back people who they tend to be founder-led businesses that have a lot of skin in the game. So they've got a lot of equity. This is really it for them. This is their be-all and end-all essentially. And a bit like how I treat my own funds, all my money's in the funds. I don't have any stocks outside the funds. We treat our own investments like we do with NAOS. And we try and keep it very simple. So we only invest in industrials. People say, why? We have an ESG screen. But just as importantly is there's some businesses out there that I just can't value. Like I'm not an expert in everything. My team's not an expert in biotech, resources, whatever. Mm-hmm. So if I can't put it on a piece of paper and explain it to you in 5 minutes, then it's probably not a great investment. And that's sort of our portfolio structure. How you pick a stock, everyone sort of tries to ask, you go through your checklist and your quant screen, all that sort of stuff. I tend to say it's a bit more of a science than a set sort of formula. And a lot of what I find is, Australian equity markets, in my view, are a lot of businesses that are listed are very low quality. So there's essentially, I think there's 2,600, this might be wrong, 2,600 companies listed. We run a screen. If you exclude the top 50, there's essentially, in our view, 100 to 200 investment grade businesses. And when you mean investment grade, like you're probably being quite lenient. that have revenue. It's reasonably predictable. You can understand the business, all that sort of stuff, gearing, things like that. So there's a lot of listed businesses that are crap, and there are a lot of listed businesses that list for the wrong reasons. People list businesses because they need money, which means it's probably a business that can't generate enough free cash flow, or they're looking to sell and get out, which is probably another not so great reason. So due to that, we look for a lot of businesses that, have delivered on commitments or statements. They can deliver on what they said 12 months ago. I think it's one of the best things you can ever do as an investor is go and get the presentation they gave 12 months ago and go through it before you meet with management. Because sometimes you can look at it and you say, you made all these statements, we're here 12 months ago, and now it's something completely different. So you always look for consistency, you look for shareholder alignment, you look for businesses that have low gearing, and you look for people that have a clear strategy. They have a clear competitive advantage and where they want to be in 4, 5, 6, 10 years' time. And then as I tell all my shareholders, we try and get 20% per annum through a cycle. But when you invest in some of these small companies that they can halve and they can double again, it's not easy being a listed business, because I find that today, even more so than 5 years ago, people are just so focused on the next quarterly result or the next half-yearly result. There's no incentive to reinvest. There's no incentive to make some of the harder decisions that are probably best for the business over the longer term. Everyone wants profit. Everyone wants a bigger dividend, and that's all sort of they're really interested in.
So you think it's getting worse?
Yeah, I think it's hard. Yeah. You look at our microcap portfolio, we haven't added one new stock in a year and a half.
Wow.
Yeah, so when I say we don't trade, we don't trade.
You sort of took us through the process there a bit. You've got 2,600 thereabouts.
Yeah.
It's filtered down through a quant screen. Yeah. Then you have these certain criteria.
Yeah.
When you speak to management, I'm assuming that you speak to them quite regularly. Yeah. What are you looking for in the I suppose, not just from like what you can read in an annual report in terms of alignment? What are you looking for from that person? You said consistency. Is there any other personal traits or anything that you look for?
They're all different, so you can't say personal trait. If I could tell you some of the conversations we have, and I think it's important. Like people say when you talk to management, like I told you, I did my Perth Roadshow on Thursday, and I think I spoke to 3 MDs in the morning. So we have a really close relationship, which is good, good and bad. So when you look for personal traits, I would say what we look for, is alignment. Obviously, the industry knowledge. So some of them have worked in a similar industry. They have the contacts. They have the knowledge. The ability to run like I say, I know it's hard, but the ability to run a public business, is key. And that, when people say public business, like, what does that mean? It's like, well, you set, objectives, dividends, capital management is a big one. How are you going to allocate your capital? Where's the best allocation of capital? Where's your highest return? As opposed to just sort of making poor short-term decisions. And really proving to the market, as I said before, that you do have a clear competitive advantage. You are creating a competitive advantage by providing a superior service at a lower cost, superior service because no other service exists. You're more nimble. You can offer a better product, whatever it is. It's got to have a clear competitive advantage so you can grow and you can scale. I think the biggest thing I've always learned is you've got to invest in businesses that can scale, and you've got to invest in businesses that aren't in an industry that's going backwards. Because I've tried that a couple of times, and you think it's so cheap, and it kills you. You just can't fight the tide. Yeah.
The reason why I asked about management is because, especially in small governance can be, in some instances, perhaps non-existent. It's something that I focus a lot of my time on. You talked about acquisitions in a recent blog post. I think maybe Ben wrote it.
Yep.
And you're talking about competitive advantage. Yep. When you look at these companies and you're looking at capital allocation, are you looking for companies that are willing to reinvest in their competitive advantage? And do you, I suppose, get your guard up when they look outside of that?
Yeah. So now we always say our investment philosophy, if a business tends to do something that is completely sort of off-piste, we tend to remove it from our portfolios. But, some great examples include, we're a big shareholder in a business called Enero. They do PR, creative, strategic insight. They're now the largest tech PR firm in the world. So they were weak in the US, so then they acquire a business in Silicon Valley and San Francisco. A natural extension of what they do, a sound acquisition. Yep. They've known the woman, Barb's, for years because they've worked together. Ticks. And the way you can sort of earn that, they go through the earn out is there's not a lot of capital put up front. So it's quite de-risked from that point of view, as opposed to a business. Even if it's a similar industry, it might be 100% cash up front. You might be gearing your balance sheet. There are no earnouts. There's no skin in the game. All the staff are leaving. You're not really getting any further extension of your product or your service or your customer base. You're just buying earnings for a short-term kick. They're the things that would worry us. Governance and whatnot in small caps is a real issue. And I've definitely learned the hard way again, more recently, that it's becoming, especially for us as, sometimes the biggest shareholder, is a lot of these businesses aren't run for shareholders. They're run for management teams. But I'm a big believer that is changing. And it's changing because I think people care and are willing to say, well, my voice needs to be heard, and whether or not you like it or not, you've at least got to listen to it. And if you disagree to my opinion or thoughts, then at least tell me why, and we all want the best thing for this business, so let's talk it out.
And so do you, as the largest shareholder, do you take an active stance against management? Have you ever confronted them over issues and said...
Oh, yeah. Had some shockers over the years, actually. Yeah, no, but even more recently, I hate the word activist. We're not an activist fund. We're a supportive investor that wants to assist a business in growing, whether it's through capital or contacts or whatever it is, directors. But no, if we feel like we're being ignored, and not only ignored, but then the wrong decisions are being made in our view, then as I said, we'll vote against, we'll vote certain ways depending on what comes up at AGMs. Make our voice heard, because at the end of the day, it's my shareholders' money. It's not my money. It's my shareholders' money. So then, that's why I'm doing my shareholder presentations. I've got to go and report back to my shareholders. But I do think it is changing a lot, without a doubt. Yeah.
When people look at the funds in the way that you invest, they probably think small caps higher risk, and they think long-term holding potentially higher risk because you're taking big concentrated bets. Yeah. How many positions are in the microcap?
Yeah, so in our small cap fund and microcap fund, I think there's 9 each. So really small.
Yeah, right. And one of the issues with that, I suppose, I mean, you're fortunate that you are in a closed-end fund and you don't have to deal with fund flows like other fund managers might have. How do you exit a position? That's a very broad question, but do you buy slowly, sell slowly?
Yes.
Is that really your choice?
If I could give a... if any of your listeners take something away from this, it'd be always average up.
Okay.
It's a good thing, I think, to average up, to average up into investments that have proven their ability in the short term or medium term, and you feel more comfortable and you feel like there is a strategy that is evolving over time and you can see the return profile being developed. That's how we tend to enter in positions, albeit I'm not going to lie, we have averaged down before, and sometimes you do. But, ultimately, when you're trying to get out of an investment, there's probably 3 ways. The worst way is the investment simply just doesn't go according to plan for whatever reason, and subsequently you decide that your risk return profile relative to what else you can invest in is not adequate anymore, so you have to exit, and then says, well, that's fine, but how do you exit? And it's like, well, you exit at a big discount. There is a price for everything, but sometimes that price will be 30, 40, 50% lower than what you paid for it, or even more if it's a really bad investment. So that's how you get out in the worst case scenario. Thankfully, we've never had any that have gone into liquidation or administration. The second way is, I suppose over time the strategy and the execution goes according to plan, but in hindsight, the financial benefits and the return profile wasn't what you expected. And so that's a long-term investment that's going nowhere. And you probably get out, just over time at a fair price, maybe the same price as what you paid. And that's happened a couple of times. And the best way to get out is obviously to have an investment, that goes according to plan. And this is how the Australian equity market works, unfortunately, is your microcap investment goes according to plan. Profit grows, multiple grows up as well because people feel more comfortable. So therefore the share price goes up. They might raise some money, to acquire a business or expand, so therefore it gets bigger. Falls into the universe of, the magical $100 million market cap figure. So then all these other funds go, well, now I can invest in it because it's big enough. So therefore we tend to sell into a lot of bigger funds because it falls into their universe. That's the best way to get out of an investment because it proved it has worked. Or the other way is corporate takeover. Someone goes, well, thanks very much. The equity market's not valuing this correctly, so I'll just lob a short-term bid and take everyone out.
You touched on something before about, firstly buying up, and then earlier you said tailwinds. Would you describe yourself as a bottom-up investor? So
Yeah,
company by company. When you are looking at tailwinds, I suppose, can you give us some examples of recent tailwinds that you've identified?
Yeah. So on my whole roadshow presentation's about it, so it's easy for me. But the 5 tailwinds that we've picked in our presentation is, I think off the top of my head. So the first one is, you say infrastructure spend in Australia. I know everyone rolls their eyes, but if you, as I said, if you look at the CIMIC presentation, which is one of the largest contractors in Australia, I think the forecast now for transport infrastructure projects is now out to 2023. I think Melbourne's overtaking Sydney as in infrastructure spend over the next couple of years. And I know in Sydney we're spending a fortune. So I'm sure you guys are about to as well. Another one is NBN, unfortunately, because it's probably not based on the world's best technology. So not only more households got to be activated, in our view, whether or not Labor gets in, there'll be a whole lot of change in regards to making more of it fibre and whatnot. So therefore NBN's going for at least another 10 years, not let alone the maintenance spend. Then we've put in other things, cyber security. I'm sure you as a digital business, I know NAOS, we've had our, not issues, but our, you come across something they're called phishing emails. So that's a big deal. Agriculture exports, as we invest in an oat and hay processing business and a blast freezing business. So you obviously look at all the agricultural exports to Asia and Europe and other places like that. They're real tailwinds. Aged care, everyone's getting older, unfortunately, including me. That's a tailwind that's not going away. So that it just makes it easier, I think, for us when we take such large concentrated positions and long-term positions. I don't think we can't have the attitude that we're smart enough to forget about the industry and just say, well, valuations are ultimately going to dictate how this investment translates into a financial return, because as I said, I've learned a couple of examples, that just doesn't occur. The market's too smart. And one thing I've always been taught as a kid, especially from Chartist, is no matter how smart you are, there's someone out there who probably always knows more than you do. So, when you see a chart tipping over or a long-term trend, and then, you think, in hindsight, that was a really bad investment, and that's the reason why. That's why I just think it pays to invest in industries where at least you've got some, even if it's a small tailwind, as long as it's not an atrocious headwind.
Yeah, fair point. I don't know if it was you that did this update, but I think it's in your roadshow on Now, where you talked about, I suppose, this herd mentality with passive investing. In your opinion, where do you see the weaknesses in passive investing with small caps? Because I'm interested to drill into that, because a lot of people probably don't know this.
Yeah. Well, I suppose the ultimate weakness is they invest in small caps that I would say aren't small caps, because ETFs are so large, so they're investing in the small ordinaries. People forget the small ordinaries is literally, I think it'd be the largest company in the small ords would be like the 101st biggest company in the ASX by liquidity. It's really not that small. Like, I would consider that a pretty successful, mature business. So for me, that's the biggest issue with passive or ETF investing in small caps. Then I suppose the ability to trade in and out, albeit ETFs I'm sure would do it well, makes it hard. But at the same time, I can understand why people use ETFs, especially in the market that we've had, because everyone will say, NAOS, look at your short-term performance, it's poor. And say, sure, if I had an ETF, I've been in the Afterpays and the Altiums and I can't think of another one. Zero. I've been in those because they're industry agnostic, valuation agnostic, and you're not. And clearly you've made the poor decision here. And that's a fair comment. I mean, you can't argue with that, because ETFs are completely removed for any psychological biases or whatever biases the fund manager may have. And we all go through it. Some of the biggest names in the world have gone through it. And it makes it hard, because as a fund manager, as these ETFs get bigger, some of these valuations are getting bigger, and that tide's getting stronger. So ultimately it's going to say, well, this lasts forever, or is the fund manager going to go out of business? That's happened. I've seen some well-known US managers that have shut down lately just because they found it too hard. So it'll be interesting to see how it plays out. But I'm still an avid believer that in small caps, and especially micro caps, because you just can't get into that space as a big ETF, that's where you can truly add value. But ultimately, for a manager to add value, and I think you're seeing this lately, is they're going to have to own fewer stocks and take bigger positions if they want to charge a fee. Obviously the days of owning 40 or 50 stocks are probably gone. in my view, because you can't hide from the index. The index will do what it does, and if you're too close to that, whether or not, even if you're 0.5% above or 0.5% below, you won't have a business case.
Yeah. Would you say that there are some systemic risks to the passive investing?
Obviously, going through the GFC, you saw a little bit of it, and I think it was interesting when we went through the correction, if you call it a correction, we had at the end of calendar year 18. Even some of my staff members, they hadn't seen this. And there were some big moves. You look at some stocks are down 5, 10, 15, 20, 25, 35% in the space of a month. I just think there's a serious issue when some of these ETFs, and there's lots of them, invest such big licks of capital in relatively small, more illiquid, I wouldn't call them illiquid, but for them they would call them illiquid businesses. And when the liquidity comes out, it'll be interesting to see what's left over and how do they get out and what price. And essentially they'll be price agnostic, they'll get out at any price. So that's ultimately the risk. But I suppose some people will say, well, for that to happen, you've really got to go through a significant change in the financial or global economic environment. And so maybe that won't occur like it did in the GFC or more recently. I think there'll always be a place for passive investing. And a lot of our clients use ETFs. But a lot of people come to us because they say, I want a micro-cap exposure. And clearly we think you guys do it well, and that's why we exist. Are we ever going to do big cap equities? No. Probably because of that reason. It's hard. And it's very efficient. Yeah.
Well, I suppose that's your fish in the pond where you can get an edge, I suppose.
Yeah, you like to think you can.
Yeah. While we're on that, when a client does come to you, what would you say is your edge?
Yeah. Knowledge.
Yeah.
Knowledge and information.
And that's gathered through meetings, through industry contacts, etc.?
Yeah, I think, a lot of it's not just spent with, I suppose the leaders of the respective businesses. It's met at the pub with clients in Bendigo. It's met at competitors, unlisted competitors, because they see our shareholdings and sometimes they approach us and and it's interesting because they're going to come to you with a massive negative view on your investment.
Yep.
So you're always, your stomach's churning a little bit while you're having this phone call. But you develop some very good relationships and they always come back, and even though they've got a different view to you, it just improves your knowledge base. So meeting with a lot of these unlisted competitors. We've got a service that we use. We can meet with a lot of ex-staff members quite easily. And just using that over many years, directors, ex-directors, customers, ex-employees, it just gives you, in our view, it gives you a great knowledge base to make a sound investment, albeit it may not represent anything in the short term. We just think over the long term, it allows us to make some smarter decisions that we can hand on heart say, well, we think this is going to develop into a sound long-term investment. It may not happen in the next 6 months though. Yeah.
Okay. You touched on it earlier on, but I'll ask it anyway. A common thread with the guests that come on this show is that the people that I speak to are typically founders or the portfolio managers. You obviously own a big stake in NAOS, and you invest in the funds. Would you ever invest with the fund manager who doesn't have that alignment?
No.
And why is that? Is it the same reason with the companies? It's just...
I just think you live and die by I've been taught my whole career, you live and die by your unit price. I had a shareholder come up to me in Perth and he was very interested in the NAOS funds and he was learning about the space. And I said, that's fine. To be honest, the first thing I said to him, I said, here you go. These are 4 managers that I would invest my own money with, and here's why. And when you go through and I was only telling him because, to be honest, I hate talking about my own funds. I find it a bit embarrassing. And those 4 managers, when I look at it, they're all founder-led. They would all have a lot of skin in the game. And I think I know, even though I wouldn't consider us a successful funds management business yet, I know how hard it is and what's required, hopefully, to be successful and to make it work. And I just think if you don't have everything or a lot invested, as you know, running your own business, I just don't think you can have the same commitment, passion and dedication to make the best decision for your investors. Because if it's your money that hurts, and believe me, I'm hurting after the last 6 months, I'll do everything I can to make the next best decision. And ultimately that should benefit me, and then it'll benefit my shareholders. If you don't, and if you can trade personally and, invest in other stocks, I just think it gets very grey. And I think that's a deep, dark place that I don't really want to go down, to be honest.
Yeah, no, I agree with you. Okay, you said it earlier on. You do road shows.
Yeah.
You do, is it 2 a year in each of the major
Cities.
capital cities?
Yeah.
Yeah, great.
Yeah.
Can anyone come along to that, or is it?
Yeah, no,
strictly investors?
we as someone told us, it was a little bit disgruntled when they were signing in on Adelaide. He was not a shareholder, but as he rightfully said, you don't have to be a shareholder. So, anyone and everyone comes, and that's the idea. The idea is just, as I said to you at the beginning, I actually enjoy it because I find I'm quite transparent and a bit cynical, but pretty objective.
Yep.
And they can just get to hear it from the horse's mouth, and especially when things are good or things are bad, they get to ask me, why'd you make that decision? Why do you still believe it's a good investment? And it's just a good way to meet your shareholder base, because we've got 8,000 investors now. So you got to try and do your best to see as many as you can.
And you get a few coming along to the events, no doubt.
Yeah, so we'll get 600, I think, this time, like across the country.
That's
which,
great.
I don't know if it's good or bad, but when I started, I remember doing my first Perth one, and I flew all the way to Perth. I think we had 5 people.
Wow.
So you got to start somewhere.
Yeah, that you do. Absolutely, you do. You've got the NAOS website. Mm-hmm. There's a blog and insights page there. Yeah. There's a newsletter that listeners can subscribe to.
Yeah, so we do obviously we've got our month-end reports if anyone wants to read those, but the one we get most views to is we do a CEO insight letter once a week, and it's literally just quotes that we've found from, like, we'll go through transcripts off Bloomberg, where, so like today, the JB Hi-Fi conference call will be on. So Bloomberg, because it's so expensive, will give you a digital transcript, and we'll go through and just highlight some of the key quotes, and we'll give people a summary of some of the key quotes that we think are quite relevant. And we send that out weekly. And surprisingly, there's actually a lot of managing directors and more influential people on that list. So people tend to read that as opposed to our newsletters, but you can sign up for as much or as little as you want. Yeah.
Great. You have a podcast as well.
Yeah, you start the new year obviously with your business goals, as I'm sure you have, and the idea was, one of my big ones, albeit I'm probably the idiot who says, well, this is what I would like to do, but I'm not willing to do it. Was a podcast, and the reason why is I listen to a number of podcasts on my phone. Mainly, you probably do as well. They're obviously in the US. I remember listening to one. Its topic was on Howard Schultz, the Starbucks guy, who's now maybe not running for president. I found it great, and I just thought there'd be there are some in Australia, but I think there aren't many in Australia that do it with, and I could be wrong, listed businesses in that mid-cap, small-cap space, especially people who I would consider in very high regard. Yep. So pleasingly, my team, unfortunately for them, sort of picked it up, and we've done 3. So we interviewed the founder of Net Wealth, the founder of Moelis and Company in Australia. He's the chairman of the Swans. What was the other one? I forgot the other. The founder of Credible. I think it's interesting. So I think for me, especially running my own business, I'm very intrigued to see how they got their leg up. How long do they have to persist for, and people key to their business. It's a big one for running my own business. The people businesses. How do they incentivize people? How do they keep them interested? How do they bring them along for the journey? Because I found as our business gets bigger, staff becomes more challenging. Keeping them involved, they want to make more decisions. Things like that. So hopefully, I think the hardest thing for us will be try and get enough businesses who are willing to go on the podcast for us.
Well, that's always the challenge, I think, with these types of shows. But I suppose you get access with your research as well. I noticed there was a blog update from you guys listing, I think it was 10 podcasts of 2018, and Invest Like the Best was on there, but also How I Built This.
Yep.
Great podcast.
I like that. Yeah, we listen to that quite a lot. I like the, because he's a random American, but the Bloomberg one with Barry Ritholtz.
Oh, yeah. Masters in Business?
Yeah, Masters in Business. I mean, sometimes you get some weird ones, but sometimes I think you get some good ones. But I listen to How I Built This. I remember the one listening to, was a really good one, the founder of Dyson. Was it Jamie?
Oh, yeah.
Dyson?
James, yeah.
Yeah, it's an unreal podcast. Some great stories
fantastic.
out there. Yeah. And I think that, to be honest, I think it comes back to the way to diverge for a second, comes back to the way we invest in Australia. So I think you look at some of these stories, it bears no recollection to the Australian equity market. I mean, you'd almost fall asleep with some of these businesses, the way they're run and, how short-term they are. If you look at some of the businesses that really innovate and want to change and make a difference and take a long-term view, I mean, how many are there? I mean, I can't think of many. Like, everyone will refer to CSL. And that's why Aussie big cap managers probably struggle a little bit, because they've got to own so much CSL because it's such a big part of the index. But it's been the best performing stock for so long. And it's a shame. My view is you'd like to see more of that come back into the Aussie equity market because all the good ones get taken off.
For sure. Okay, last question. Yeah. If you could go back and tell a younger you something about finance, money or investing, what would it be?
Like with our own money or just...
Just you, personally. Could be something, a personal trait, could be...
Oh, look, I mean, I'll cop out and say obviously enjoy what you do and work. And I think for me, enjoy what you do, persist. The amount of times I've been knocked down in quite a vicious way. I think some people probably wouldn't get back up. But just persist and be transparent, put your cards on the table. You can take note, but especially as I've got older, when I was younger, I wasn't like this, but listen to people's opinion, especially some older people around you. I used to be probably a bit obnoxious and think it was a joke. But I think now I look back and think, that was quite smart. These people have been around for a lot longer than I have. So I think if you can enjoy it, listen to some smart people and persist and really, really get stuck into it, you can do whatever you want, whether it's in finance or industry or whatever it is. That's sort of what I would take away from my last sort of 11 or so years.
Great advice, Sebastian. Thanks for joining me on the show.
Thanks for the opportunity.
Thanks again for tuning into the Australian Investors Podcast. For further episodes, head to www.raskfinance.com. To provide feedback, nominate a guest, or hear from me, you can find me on Twitter with the handle @OwenRask. Cheers to our financial futures.